Got the S&P Case-Shiller going negative, like we called. We got the new homes sales number, which was shocking. More on that in a minute. We got some data from Altos Research. Shout out Mike and the team at Altos Research. Lots and lots of stuff going on, including Blackstone becoming a seller. So let's get into the news today. There's lots and lots going on. Let's first start with new home sales. New home sales came out today. You heard me over the weekend and again yesterday basically call out the experts. I don't know what these experts are thinking. Let's remind you what happened. Last month, we did 680,000 sales of new homes. The experts were calling for 675. What are these experts doing? Can you believe that the experts were calling for last month to be down from the month before? I don't understand. So I called 703 and I said massive, massive beat. Truth be told, I wanted to call 750, but that just seemed crazy. I mean, if the experts were calling 675, I figured 750 was nuts. So I lowered it to something over 700. I called 703 publicly with you. Well, the number came out this morning and I'm just going to call it everybody was wrong. It's just shocking these experts can be so wrong. So here's the number. The number came in at 763. 763,000. That is a beat of 12.2%. You experts suck. Are you not in the market looking at homes and realizing that new construction is crushing it? 763. That is almost up 100,000 units from the month before. Not to be unexpected. As many of you know, I spent 3 weeks in Las Vegas shopping for a home, and it's rough out there. That's all I have to say. So again, massive beat, 763. I'm going to even call my 703 a miss because while I was closer, it wasn't particularly close, so I was wrong also. That is the market telling you. The builders are in the right spot. Their competition, existing home sales, no bueno, not good. It's just not there. Too many people locked in, no listings. It's rough out there for existing home sales, realtors, things of that nature. But new home sales, I don't know what the doomers and crash bros are going to be saying now, but I'm sure they will come up with something. How about Blackstone? Man, Blackstone is in the news. So first and foremost, Blackstone is selling warehouses. They have a collection of warehouses they are selling to Prologis for $3.1 billion. $3.1 billion. So when I see Blackstone selling, I ask a couple of questions. One, are they calling a top in that particular segment? I would argue that warehouses are very, very strong, and maybe Blackstone is saying, hey, we are approaching the top in this area. Two, is Blackstone in need of cash? I think like all real estate firms, Blackstone is absolutely in need of cash. They have people requesting from their private REITs and all of those. So I don't know why Blackstone would be immune to this. As one of the largest owners of all real estate, I would imagine that Blackstone needs cash as well. Not to be outdone, Blackstone is also considering the sale of 50% of the real estate under the Bellagio Hotel. If you don't know this, Blackstone bought the real estate for $4.25 billion in 2019. Anybody think there hasn't been some appreciation in the land value underneath the Bellagio Hotel in Las Vegas? So again, Blackstone is looking again to possibly raise some cash by selling up to 50% of the land that they purchased. So again, a lot of selling going on. I believe what's happening, if you guys don't see it, in First Republic. First Republic is going to be a problem. First Republic, obviously, I think was just acquired. I think it was by JP Morgan. What we are seeing now is there was a whole segment of the economy, including multifamily, that was reliant on First Republic. And what we are seeing now with First Republic gone is there's just no liquidity for buyers, refis, things of that nature. It is really, really scarce out there. You are getting quotes, but people are not funding. So again, this could just be a sign of liquidity that Blackstone wants to add some more cash so they can survive to 25. Let's talk about Altos Research. Folks, if you're not following Mike Simonson from Altos Research, you are missing out. He is both very active on Twitter, which is where I follow him. He also has a YouTube channel. Here's some numbers from Mike yesterday. I actually retweeted this. You can follow me at One Rental at a Time on Twitter. Basically what Mike is proposing, and I got to admit, this is something I have not thought about. Mike is basically saying, hey, demand, aka buyers, might be more sensitive to the rate of change than the actual interest rate. What does that mean? Last summer, around this time, we saw interest rates spike to 7.37%. The rate of change was exceedingly fast. We obviously came back down and blah, 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 but now we're kind of settling around 6.8, 6.9, 7%. What Mike is proposing in Altos Research, and again, Altos Research has the most up-to-date information. If you are trying to figure out the market, Altos Research has the most. It is the active listings, what is going on today. So shout out the team for all the value they bring. What he's saying is we are seeing demand firm up because as rates stay stable, consistent, buyers are coming back. So right now we have 460,000 single-family homes on the market. That is up 1.9% week on week. But when you realize and compare last week to last year, the rate of change is really telling. The rate of change for this week last year was 6%. We were getting more inventory. So yes, it's nice to go up. I suspect in the next 2 to 3 weeks, we will be negative year on year. That's where we are unfortunately going with inventory. To talk about how hot the market is, 84,000 listings came on last week. 21,000, or exactly 25%, went pending. They call those immediate sales. So 25% of the listings from last week are gone already. That is still a relatively hot market. So again, if you're not following Altos Research, you should. How about Case-Shiller? Again, I want to call out. We are going to see some doom porn that is going to try and scare you. Don't be scared. I tried to tell you yesterday that the Case-Shiller would be negative year on year. In fact, on January 2nd of this year, I told you that we are going to have 3 or 4 months of negative numbers. This is month 1. Case-Shiller is negative 0.2% year on year, the first time since 2012. Let me make sure I got that right. Where did I write that down? I believe it is, yeah, first time since 2012, the national housing market has a negative year on year print. Not to be unexpected. It was baked in the cake. And let me tell you this right here, right now. Next month will be negative also. The month after, negative also. We have to pay for the sins of last year. Do yourself a favor and go look at the summer of last year and realize that markets like Seattle were so unhealthy. The average purchase price was 112% of ask. That is not normal. That needs to be repaid this year. We will have 3 and quite possibly 4 negative year-on-year numbers from Case-Shiller. This is the first one. They will get bigger. We are down -2. There is more coming. Don't be surprised. But let's talk about month on month. Month on month was actually up 1.2% if you look at May versus April. How about some durable goods? I don't know if you saw it this morning, but durable goods came out this morning and another monster beat. I don't know what else to call it. Durable goods were expected to be down -0.8%. They were actually up 1.7%. That is a triple. They beat it by a triple. Expected -8, got 1.7, negative 0.8 to be clear. So again, and that is up from the month before, which was up 1.2%. I have to tell you, my recession call for Q2, not looking very good. I am going to likely have to own that error and that mistake. And I will, because when you take guesses like me, you make mistakes. So my recession call for Q2, not looking very good, and I need to own that error and wear the swing and a miss shirt. How about Robinhood? Again, these are things we talked about on this channel. Tech companies have routinely not cut deep enough or fast enough. We often go through 3 rounds of layoffs. Robinhood just announced another 7% workforce reduction. They're getting right-sized for the current environment, and this is to be expected. There will be more layoffs in tech as companies right-size, and frankly, as companies go bankrupt. Don't know if you saw it this morning, but Lordstown Motors have gone bankrupt. Chapter 11 bankruptcy. Lordstown Motors files for bankruptcy. Since we're on the subject, Walgreens reported earnings and they slashed guidance, missed on earnings. They are going to raise their cost-cutting measures to $4.1 billion. And obviously, if you don't know, a lot of cost-cutting means reducing headcount. How about Bank of America? Bank of America came out with an interesting report that says national home prices have bottomed. Bank of America thinks that national home prices have bottomed. Fannie Mae expects the 30-year mortgage to drift down to 5.6% by the end of 2024. Goldman Sachs thinks by the end of 2024, we will be at 5.9%. 2024 is what, 18 months away? Hard to guess. But yep, I would guess we'll be under 6% as well. How about Fannie Mae? Fannie Mae's chief economist, Doug Duncan, says that home prices continue to show stronger growth than previously expected, giving high interest rates. Housing will be supportive of the overall economy as we exit a modest recession. Folks, I think what we are going through is something we brought to you very early on this channel, something called a rolling recession. A rolling recession is like housing going into a deep dive a year ago, now coming out of it. Retail going in, then will come out. Travel is up, travel will come down. Again, a rolling recession means different sectors or segments will feel it at different times and be rebounding when others are struggling. There's just a lot of stuff going on. But again, great report today. New homes blew it out more than even I expected. Case-Shiller went negative as we expected. And then lastly, let's not forget, I'm throwing a very, very special event for you on July 16th, Saturday, July 16th from 8 to 11 a.m. Pacific. You are going to get to interact with Dan Bird, learn the tricks of the trade, how he has been calling the market right for a year and a half on this channel. Again, you can go back, look at his playlist, see what he got right, see what he got wrong. His batting average is better than most. You have to check this out. Again, I'll leave a link below for the Eventbrite. We have allocated 200 seats. It will be recorded. And if you buy the event, you will get the recording. That is my commitment to you because trust me, I've worked with Dan Bird for 20 years. When he gets going, it will be a flood of value. You will want to watch this again. The $47 is ridiculously cheap. The value that he's going to bring, the position sizing, where to put your stops, just risk profile, charts, all of these things. And he is going to give you an hour to look at your stock. So again, folks, if you're not buying this, you're truly missing out. The link will be below. It's only $47. I think we have 38 seats sold already. So what's that? 20% are already sold out. Don't miss it. These will sell fast once people realize the value being given. Alrighty, folks, have an amazing day. Lots of great stuff coming. Again, new home sales, 763. The experts thought it would go down. What are they doing? Like, subscribe, comment, become part of One Rental at a Time. We are on the path to 50,000. I need you to subscribe. I need you to ask your friends to subscribe. Let's blow up the channel. If you want, you can follow me on Twitter. All these great things. Again, please subscribe on YouTube. We want to get to 50,000. Ask your friends to subscribe. The sooner we get to 50,000, the sooner I spend some money on an event in Vegas. Take care. Bye.